In this video, there's a lot of great content about trading tactics and techniques that you can use to become a much better investor. It's all based on the content in the Market Manifest, a free report available on peterleeds.com. So let's get into it. We're going to show you how to become a great investor from a point of being a pretty good investor, or an average investor, or a newer investor. We're going to get up to speed no matter what. Nothing in this video is intended as personalized trading advice for you. Which leads me into the next thing I want to talk about, the trading of sympathy. Flocks of birds often travel together down to their turns and hard cuts and landing zones. Often, an entire industry group will trade together like a flock of birds. Sometimes, one individual company will trade in a certain way, opposite from or different from the overall industry. That's when you know you have a problem or a benefit. You own one specific company that increases 20% in value, but the overall industry didn't move over that time. That means that that company that you're talking about that made 20% is doing great, and maybe they have a lot more upside going forward from this point. But what if stock that you have drops 15% and you kind of get a little bit spooked and you go and look into the other companies in the industry? A lot of times they will have dropped by an approximately equivalent amount, and so then you know it's trading in sympathy, which is very different than company-specific risk. The company you're looking at is not having a problem specific to that company. It's just that the entire industry is declining together. Barriers to entry. This is so important. Barriers to entry involve things that make it harder for another company to get into the space. So say, for example, a nuclear power plant. There's immense barriers to entry. You can't just get a few friends together and say, we're going to start a nuclear power plant. A lemonade stand has almost no barriers to entry. A t-shirt company. If you want to open up a local gym, the barriers to entry is that you have to get all the equipment and the location. There has to be enough people to support your business. What you want ideally is to invest in a company that's operating in a space, such as robotic surgery, for example. They're already operating in that space. And it's incredibly difficult for new competition to show up in that space because there's so many barriers to get into the point of being operational in that environment. The lower the barriers to entry, such as for a lemonade stand or a t-shirt company or marriage counselors, the worse it is. If you're investing in a company that operates in any of those spaces, like a lemonade stand, for example, the reason is that low barriers mean more competitors. But the higher the barriers to entry, the harder it is for new competition to emerge. You want to invest in a company that's operating in a space with only 2 or 3 companies in the space. This video is inspired by the following testimonial. I don't always agree with you, but I'm more than willing to say that I trust your information, analysis, and perspective as much as anyone I personally know or anyone that I choose to watch. You're fantastic. That's from our showers. Market share. This is one of the best ways to watch how well a business is growing. When you have a company that you want to invest in, and they have a 5% market share. For example, the market for organic socks is $1 million a year. There's $1 million a year of consumers purchasing organic socks. And this company has 5% of that market. You know how much money they make, and you do the math, and it's 5% of that total amount. Now watch for a company to have an increasing percentage that they own of that market. If there's a set limit to how much of a market there is, and then that company now owns 20% of the total market, and then 25% of the total market, that's a great investment in that space, assuming that the market itself is large enough to support this company and all the other companies that are going to be operating in it. Any business has a total market share. For example, imagine there is $200 million spent on robotic surgeries per year on average. If a business brings in $50 million in sales, they have a 25% market share. If the market increases to $300 million, but their revenues remain flat, they're actually losing more to their competitors, as evidenced by the declining market share. You're looking at the percentage of the market they own. The market could increase in size, and this company keeps making the same amount of money, even though the market increases size. That means that they're actually declining. And if you have trouble finding out what the total market is, best way to do it, and most people don't do this, is you call the company's investor relations contact and ask them. They're not going to bite you. And if you want more, it just continues right through this video right here. We just left off and we're going to keep on rolling right starting with that one.